Joining us right now is Hough. He is senior editor at Barron's. And Jack, thanks for coming in.
Thanks for having me.
Let's talk about this amazing buyback story. You're talking about more than $650 billion overall of companies saying that they're going to be buying back stock, and that blows away the previous record.
Yeah, and you can think of that as a buyback yield of 3%. You know how sometimes we look at the dividend yield of the market, a couple of percent right now. We'll compare that with what's going on in bonds. So call it a 10-year Treasury yield of 3%. Mm-hmm. But really, the makeup of how companies spend their money has changed dramatically over time, and right now they're spending a ton on buybacks. So the yield of the market is really more like 5% when you lump in the buybacks and the dividends.
Because if you're a shareholder who's owning that, you are owning a bigger piece of the company.
Yeah, it reduces the share count, and it ought to make the shares of the company you own more valuable. It doesn't always work out like that. There are plenty of examples of companies that spend money on shares and the shares go lower. You can ask GE about that, or IBM. The way I would tell you is this: buybacks will make a good stock better, but they won't make a bad stock good.
Right. Let's talk about companies that you think should be buying back more shares that aren't. Who's at the top of the list?
I think you have to look at Alphabet. There's a ton of cash right now. You want to look at a company that's reasonably priced to begin with. A stock that you would buy on your own is basically the test. And we think Alphabet looks attractive here. There's a duopoly formed in online advertising. Money is flowing to them and Facebook rapidly. And they have more cash than I think they can reasonably use right now. And as we see rates come up a little bit, that cash becomes more valuable to investors. They'd like to see it put to work. I think it could be put to work in Alphabet shares. I think Berkshire is another candidate. You know, Warren Buffett has a test for when the stock gets cheap enough relative to book value.
120% of book value.
120%. It's probably time for him to nudge that up a little.
Why? Is that just because of valuation? I mean, we spoke with him, and I think it was in February. He told us they'd consider moving that higher if they couldn't find other deals in the stock market. He still has over $100 billion in cash.
Sounds like he might push closer to 130% at some point, or just below. But look, at least he's putting more money to work in Apple, which we think is a very attractive company. And Apple, of course, is buying a ton of its own shares. So indirectly, he's at least putting money into something that's buying back its own stock.
But you don't think there's any value in Apple taking that $100 billion and going off and think about all the companies that they could buy with that money?
Sure, but
you think there's nothing out there that's better than their own stock?
It's just that they have so much cash, and they generate so much cash.
And they generate so much cash.
$65 billion a year in free cash flow, tons of research and development, plenty of opportunity to buy other companies. If they wanted to, they could borrow as cheaply as anyone under the sun. At this point, especially with the tax cuts, which amount to found cash for them, there's less cash that they need to keep on the books right now. And I think that stock's attractive. I think, you know, we talk about the race to $1 trillion market value. I think Apple easily looks like it is the front runner. I think it will win that race.
Unless they keep buying back stock like that.
And I think it will win that race to $1 trillion soon.
Even though they buy back stock.
Yeah, I mean, even though they buy back stock, which acts as a headwind to that market value. But yeah, Apple's very attractive. Everybody talks about the phone cycle, the disappointment with the past phone cycle. Yeah, but profits are still doing well, and any disappointment you have there means the next one looks good.
Would you just say that even if you're buying back stock, it's better than leaving it overseas? You know, people get so disappointed when they buy back stock
because you want to see CapEx.
They want them to just CapEx or just raise wages or whatever, and just don't make rich people richer that own the shares.
I'll meet you halfway. I think CapEx is going to look pretty darn good this year, and I think there is some political pressure on these companies. We've seen Apple, in the same breath that talks about these buybacks, it's also talking about CapEx. So I think companies are under pressure to show some investment here domestically while they're buying back tons of stock.
But you don't, you don't overbuild the things you don't need with CapEx necessarily. You don't want them to do that. You don't want them to just arbitrarily decide to build an extra factory that you don't need.
Right. And the shift, also the composition of the spending has shifted now. They're buying a lot more technology. So in the past, we'd be looking for big construction. Suddenly it's money spent on Red Hat, Salesforce.
You were so bummed when they bought Beats, remember?
That was not a needle.
Who do you want them to buy? And anyone you buy, it's so expensive. You know, their value.
No, but the question is, would you want to own a telephone operator? Would you want to own a cable company?
I don't know. Everything's expensive. I don't know any. I don't know. Should you do it?
Disney. I mean,
you better make the right move, though.
Right.
Yeah.
And buying yourself, which you know all about, and it's the most valuable company on earth, and you know exactly what you're going to do because you're running the company. Buy that.
And by the way, though, on the other point, though, of whether the buybacks are helpful versus the CapEx, the question was never, is it better to be here than not? It's, could you construct a system so that when the money gets brought back, that it's incentivized to ultimately.
Yeah, but would you want to do that? Would you?
Yeah, I do.
The best laid plans of people, you incentivize one thing, and the unintended consequences end up doing something else. Just let it work. Let the market.
It's all money that works its way back into our economy.
But there was an argument with you about whether you should just leave it over there, because if you bring it back this time, then they're going to do it again, so that they can bring it back again. Remember?
Well, no, but now we have
changed it to 21.
That was when we were talking about a holiday.
But you're okay when they buy back stock with the money with the repatriated earnings now? You're okay?
I am okay. I wish that we had come up with a tax system and strategy that would have figured out a way to incent CapEx over the long term.
Do gooder.
That's what I would have preferred.
I don't want to come in between you two. I enjoy it when you get going like this.
Yeah, that's my job. Thanks, Jack.
Yeah, she sits right there.
Overall, though, you do anticipate it's going to be the biggest year ever for stock buybacks?
We think it'll be the biggest year, and the market to us still looks reasonably priced, and earnings growth is good. So I think this money that's plowed into stock buybacks will be, for the most part, money well spent for the market as a whole.
Jack, thank you for coming in today.
Thank you.
By the way, the Barron's cover story is called "Why the Buyback Boom is Bullish for Investors."
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.